Are you looking to grow your wealth through equity mutual funds? Do terms like large cap, mid cap, SIP, and expense ratio sound confusing? Don't worry, we've got you covered. Welcome to Investor Owl, where we simplify finance and help you make smarter investment decisions. Let's dive in. What are equity mutual funds? Equity mutual funds are investment funds that pool money from investors to invest primarily in stocks. These funds are managed by professional fund managers who strategically allocate investments across different companies to generate returns. How do they work? When you invest in an equity mutual fund, you are essentially buying units of a fund that holds shares of multiple companies. The value of your investment changes based on market fluctuations. Types of equity mutual funds. Equity mutual funds come in different types based on market capitalization and investment strategies. Type 1, large cap funds. Invest in well-established companies with a stable growth rate. Type 2, mid-cap funds. Invest in medium-sized companies with higher growth potential. Type 3, small-cap funds. Invest in smaller companies with high risk but higher return potential. Type 4, sectoral and thematic funds. Focus on specific industries like IT, pharma, or banking. Risks versus returns. Like any investment, equity mutual funds come with risks. The market can be volatile, but historical data shows that long-term investments tend to yield positive results. SIP versus lump sum. Which is better? SIP, Systematic Investment Plan, allows you to invest small amounts regularly, reducing market timing risk, whereas a lump sum investment involves investing a large amount at once. SIP is ideal for beginners, while lump sum can be beneficial in a bullish market. How to choose the right equity mutual fund? Before investing, consider these factors. 1, fund performance history. 2, expense ratio, lower is better. 3, fund manager's track record. 4, investment goals, long-term or short-term. Best strategies for long-term investing. To maximize returns, follow these strategies. Start early and stay invested. Power of compounding works best over time. Diversify your portfolio. Don't invest everything in one fund. Review your investments regularly. Check fund performance yearly. Avoid emotional decisions. Market fluctuations are normal. Equity mutual funds can be a powerful tool for wealth creation if used wisely. By understanding their working, risks, and strategies, you can make informed financial decisions. If you found this video helpful, hit the like button, subscribe to Investor Owl, and share it with your friends. Got any questions? Drop them in the comments section below, and we'll answer them in future videos. I'm Prasenjit, and this is Investor Owl. Thanks for watching, and happy investing.